There's really a very important aspect of the current situation that has to do with the banks that it's very hard to address because it's so deeply ingrained in the minds of everybody that it's natural, but it is not, and that is competition. You know, economic and financial or let's say competition for money between companies is artificial. It's not a real there's not a real reason for it, and I can explain why. Because companies compete by investing and by by lending money from banks, and the banks are basically in business to do those things, to extend loans to companies. Everybody knows that. When you have a new invention, you write a business case, you go to a bank, you borrow money, and you start making it. That's, let's say, the standard process that you accept as a business process. And you have to realize that that's completely bogus and nonsense. Why? Well, first of all, if you have a good product, you should be able to manufacture it and sell it with a profit. You can start small and then grow. But much more importantly is that that's exactly the artificiality of the competition in the marketplace. The fact that you can go to a bank, collateralize a promise, get money that the bank didn't have before you came around, and then enter the market more powerful than you actually are. Of course, that causes a stir in the marketplace. You can think of a simple example of a village with two shoemakers, and they make shoes for the village, and there's enough shoemakers there, so let's say the whole village is helped by these two shoemakers. And a banker enters and he thinks, this is much too boring, first of all, and second, I want to have those shoe shops. So he goes to one of the shoemakers and he says, you can buy a machine if you had the money, and then you can produce much more shoes and you can be much more wealthy. And maybe this is a common sense shoemaker, so first he resists a little bit, and then he dreams about it and gets told all kinds of stories of what he can do, and finally he agrees to get the loan from the bank. Then he buys the machine, he produces 2 times or 4 times as much shoes at a slightly lower quality, and the other shoemaker after a while realizes that he's losing market, and he has to go to the bank. And after a month or so, both shoemakers have loans with the bank, pay interest to the bank, and are making shoes at a higher volume, which is not necessary. So they both have to compete on price, and the price goes down, and after a while they're stuck. Because you might think that competition drives the price down, but of course it doesn't drive the price down if everybody is extended loans and has to pay the interest on those loans. Then you'll see people trying to maximize the price within the margin of possibility. That's in a nutshell the artificial situation that banks create in society. And if banks were not able to extend loans of capital that they do not really have, then it would be a much better world. And then you would not have corporations trying to build bastions with legal all kinds of protectionist schemes. Because you see, every time somebody investigates industries and tries to look for price agreements and cartels, they are found. Everywhere in Europe we have Nelly Smit-Cruz looking into it. Everywhere in industry where she looked to see if there were price agreements or illegal dealings, she found them. And much more than saying, God damn it, they should compete, I think people should say, God damn it, that's the way to go. But because there's already the competitive environment, it leads to artificial high prices. If the competitive artificial environment was not there, then you would see that everybody would be dividing the market amongst themselves. Because that is what people ultimately want. They want to have a wealthy society where everybody can live in peace together and do their job, and be honorable and proud of what they do. And that's completely fucked up by the banks. I hope this is interesting, and thanks for listening.